What's up, everybody? This is Heresy Financial. Welcome to the channel. This is where we talk about financial education and topics that are considered heresy to the financial establishment. Today, I apologize, you can't see my face. What we are doing is a quick lesson on technical analysis. Now, for those of you who are not familiar at all with what technical analysis is, basically there are two camps with analyzing financial information for stocks or any tradable securities like futures or options or other things. Basically, you have two things. One of them is fundamental analysis, and the other is technical analysis. Now, if you're looking at earnings reports, if you're looking at news, if you're looking at financial ratios like the price to earnings ratio, if you're looking at balance sheets, cash flow statements, the financial statements from the companies themselves, that is fundamental analysis. That's what that is. You're looking at the fundamentals, the financial information regarding the company itself, and you're then basing your investment decision on what you see there. Do they have a good outlook? Are they burning through their cash? Are they stockpiling cash? Are they growing their revenues month after month, quarter after quarter, year after year? Are they growing their profits? Are they reducing expenses? Things like that. You're just looking at the basic information about the company. Now, most mutual funds that are actively managed mutual funds do fundamental analysis. And nowadays, it's mostly computers that go out there and they'll scan all of the information, they'll scan all of the data, and they'll automatically pick companies for the funds that meet certain criteria already. So whether you're looking at a rating company or a mutual fund, usually any of these things, they're looking at fundamental information about the company. That's not what we're doing today. This is the kind of the opposite camp. This is called technical analysis. So the theory behind technical analysis is that anything that is fundamental to the company, any news or financial information, is already going to be baked into the price of the stock at any given time. Because there are so many algorithms, so many companies, so many stock raters, so many analysts, and so many mutual funds and institutional investors analyzing all this data, that all of the big money has already, all the big money pretty quickly acts on any new information. So by you as an individual going and looking at this information, you're likely not going to spot anything that big money hasn't already spotted. And so if you see, in the financial information, if you see that the company has, a good outlook for being able to increase their revenue next quarter, well, chances are the billions of dollars out there that are already looking for good investment opportunities like that have already seen this company, and they've already put money into the company to preempt this move, and that has driven the price up to the expectation of what it should be worth already. So what the technical analyst does is says, hey, all that information is already baked into the stock price at any given point. So what I'm going to look for is trends. I'm just going to look at the chart and see what the chart tells me about the pattern, about the behavior, about the habits of the people, the investors, the institutions that are putting money in or taking money out of the stock. And what you see over time develop is patterns that are semi-repeatable, that you see repeat themselves, and that they play off each other. Patterns that you can recognize that might give you a little bit of an indication of what it might do just based off of psychology and group play, group movement, kind of the mob mentality in stocks and in investing moves things to a semi-predictable pattern. And so over time, people have witnessed and observed and noticed patterns develop in charts that correspond to financial data that has already come out. So what we're going to be doing today is looking at some of the most simple forms of technical analysis that are the most common out there, because with technical analysis, the more people using an indicator, the more likely it is that indicator will work, because it's kind of a self-fulfilling prophecy. If everybody thinks the stock is going to bounce off of 2,800, then people will buy it once it hits 2,800, and that will drive the price back up, and so it will bounce. So a lot of technical analysis is a self-fulfilling prophecy. So we want to look at the most commonly used indicators out there. So you can see my screen. This is just a chart of the S&P 500. This program is a free program that Charles Schwab puts out if you have a trading account there. So if you like the way this program looks, you can go there and get it. I'm just used to it. You can use any other program, TD Ameritrade, E-Trade, Fidelity, and others, Interactive Brokers, TradeStation. They all have their own programs out there. You can just play around with them and take your pick. But I'm used to this one, and they all have the similar indicators and ways of using the program, and so it shouldn't be too different from what you are used to. This is a chart of the S&P 500. So when most people are referring to the stock market, they're just referring to the S&P 500. It's the most common way to measure the stock market. This is a chart. So the first thing we're going to do is look at the individual components here. You'll notice there's these little things. They're called candlesticks. They look like big fat or short bodies with little wicks that stick out the top and the bottom. They're either green or red. I'm going to zoom in a little bit further here to show you here. If it's green, like this one, it means that during this time period, the stock opened here, and it is currently here or closed here. And then the wick is where it has moved in the middle of the day in between the open and the close. Now, if you see here, I'm on a daily chart, and that means that each one of these little candlesticks represents one day. So this is the latest one. So today, this price at 2861 roughly is where the S&P 500 opened for the day, and then right up here at 2886 roughly is where the S&P 500 currently is. It's come up here let me zoom in. It's come all the way up here at one point during the day. It's come all the way down here at one point during the day. This is the candlestick. This is the most common type of chart that people will use. It just, at a glance, gives you a lot of information about where, for that day, where the stock or the index opened, where it closed, and what the highs and lows were for the day. Gives you a lot of information at a glance, and so that's why people use it. It's the most common. The second thing we're going to look at is this big yellow line. It's a fairly steady line. It doesn't move very quickly, and by moving quickly, I mean it doesn't have a lot of volatility in it like some of these other lines that you see on my chart. This yellow line is pretty straight. This is the simple moving average of the last 200 days. I'm going to break that down. Everywhere you see this line represents an average, a simple average, just adding it all up and dividing it, of the last 200 days. And so right here, that was an average of the 200 days before right here. And then if we zoom back a little bit down here, that was the average of 200 days before that. And so what you end up with is a very long line that doesn't bounce around a lot because it's just the average of the previous 200 days. Now, this is one of the most commonly used indicators in technical analysis. And if you see, a lot of times the price bounces off this line. Again, a little bit of a self-fulfilling prophecy. Right here, everybody expected that the 200-day moving average would be as low as it would get. And so as soon as it got there, everybody bought, and it drove the price back up. And it happens over and over and over again. Now, I'm going to pause there and explain a little bit why. When you're looking at price action for stocks or indexes, think about floors and ceilings of a building. One of the most foundational concepts to understanding technical analysis is support and resistance. It's just floors and ceilings like a building. So if you break into a floor above you, that what was your ceiling is now your floor. And then if you go down a level, what was before your floor is now your ceiling. So stock prices and index prices tend to show similar behavior. When you have a ceiling or a floor on the price, something that a price that the stock has bounced off of many times, Usually what that means is that it will continue to bounce off that. Whether that's above or below, it will act as something the price will try and bounce off of. So we see that right here. Over here, the price bounced off this line right here, and right here, and right here. And then so it was a ceiling. And then as soon as it broke above, now that's its floor. And so it bounced off of it as a floor a number of times. When it broke back down below, it bounced off it as a ceiling again. Ceiling again here, and then as soon as it broke above, now it's a floor. Bounced off here, and then we had a brief false breakout, but again, it bounced back off. And so obviously it's not perfect, but you can see this concept called support and resistance. If it's currently above the line, then that line will probably act as support. If the stock is trading below the line, then it might act as resistance. So it's just ceilings and floors. And so this indicator, the 200-day simple moving average, is usually a good support and resistance line. If it's below it, it wants to bounce off and stay below. If it's above, it wants to bounce off and stay above. And so people use it, and therefore it is a little bit of a self-fulfilling prophecy. The last indicator here that I want to talk about is volume, and we'll have to switch over to a regular stock instead of an index, because an index is just a list. It doesn't actually have volume. And so let's look here. Let me increase my volume panel down here so that we can see it a little bit more clearly. And let me clear up my chart here so that you can not be distracted by all of the other things that I have on my chart. So here all we have is the candlesticks representing the price of Amazon, the 200-day moving average, and then down here we've got the volume. So each one of these little red or green lines down here represents 1 day's volume. And now they're red or green just based on whether that day was an up day or a down day. But the lines, how tall they are, how short they are, represent how much trading volume took place in this stock on that day. And you can see over here, let's see, where does, okay, it's over here. This is where it shows the number of shares that were traded. So up on this day, you see it was 9.1 million shares traded, whereas yesterday, it capped out at 3.1 million. And then we've got the blue line here, which here shows it's just this simple moving average of volume. So over the last 30 days, the average volume is 3.6 million shares traded per day. Now, the reason why volume is important is because it shows the power or the momentum or the weight behind different price movements. On declining volume, when volume is going down, that makes that price movement less impressive. When volume is increasing, that makes that price movement more impressive. And that just means that there's the more volume you have going into price movement, the more power and intensity and velocity between shares trading hands you have. And so it lends to, with a lot higher volume, if the price is increasing on increasing volume, that means that on average you have a lot stronger of an indication that there's more and more and more money coming in. Whereas if volume is decreasing when the price is rising, that's a weak price move. That means trading is slowing down. And so you might see that trend reverse if volume is decreasing. So we're going to stop there today. That's probably just a drop in a bucket as far as everything that you can get into a technical analysis. This is kind of just a very introductory video here. And what we covered again was just what a candlestick is. It represents the open, close, the high, and the low, and the color represents whether it was a down or an up day. Each candlestick represents 1 day. This yellow line, which you can make any color you want, is just a simple moving average of the last 200 days. And it acts as what's called support and resistance, which you can think of like floors and ceilings. And so you can see here on Amazon, it was stuck below for a while and then it bounced above. And so if something is, bouncing off of a floor, and it breaks through, then what was its floor will probably now become its ceiling. And so that's what support and resistance is. If that's all you know about technical analysis, you're going to be playing with probably 75% of all technical analysis out there. That is the weightiest portion. That is what is given the most credence. Volume, simple moving averages, and support and resistance lines. All the other fancy stuff out there can give you a little bit of an edge, but not much over that. That's the meat. That's the meat of the meal. So let me know what you think. Let me know if you have any questions. And thank you so much for watching. You guys have a great day.